Good afternoon, everybody. Thanks for tuning in once again for this month's installment of our webinar with our favorite co-host here, Charlie Bilello. So, Charlie, thanks for joining us.
Awesome. Great to be with you guys.
Yeah, for anyone if this is your first time tuning in for this webinar series that we do, if you don't know Charlie already from being all over Twitter and all over the socials, talking about investing, as well as being the CEO of Compound Advisors, you should get to know him, follow him. He's always got great insights, does amazing things with charts, which is kind of what brings us to, this installment of the webinar and what we do each month, which is get together and look at some of the hottest trends over the last 30 days and look at them the way that only Charlie can, and some great pictures using charts and using those to tell the story. So let's jump in. We've got a handful of topics to cover today, as usual. Those include, some highlights from a few posts you made, as well as some trends from last month. Is the market always right? You always have trick questions, Charlie. So whenever I see your questions, I always assume there's a trick there. But why 0% rates make 0 sense, the great normalization, reaching for returns, and then everyone's favorite topic, the meme stocks. We'll touch on those a little bit at the end.
Awesome.
All right. So first question, is the market always right? Talk us through this a little bit.
So there's this notion, you probably heard it before, that the market's pretty efficient, gets things right most of the time. And I would agree with that. What people don't mention with that statement is that at extremes, market can be very wrong. And there's a reason for that. And that's investors are not always rational, right? Sometimes they get extremely exuberant, irrationally exuberant. Sometimes they get extremely depressed or despondent. So that those emotions, those human emotions, lead to every once in a while at extremes, the market, being wrong and very wrong at the worst possible time. So this first chart here is a price of silver, and some of you on this webinar might not have been born yet in 1980, but just a little history lesson. There was just a huge mania in silver, and really starting in 1979. There's these guys called the Hunt brothers. I think it was 3 brothers. They were in the oil business. They were billionaires essentially, and they saw inflation running away, and they came up with this idea that they were going to corner the silver market. And essentially what that means is try to buy all the silver. And they came pretty close. I think at one point in 1980, they had bought roughly half of all the silver market. The problem is that they did much of that on margin. So I think they only had about 20% or 10 or 20% down on that money. And then in early 1980, the futures exchanges on a day, I think it was called Silver Thursday. So you probably heard of Black Monday, but I'm sure not many people have heard of Silver Thursday. On Silver Thursday, they decided to raise the margin requirements on silver. So they had to very quickly come up with $1 billion in cash to meet those margins. And guess what? They didn't have $1 billion sitting around in cash. That led to just a collapse in silver. Within a few days, it was cut in half. And even today, 40 years later, silver is half of the price it was at its peak in 1980. So the market obviously got this one in early 1980 pretty wrong at the time.
Yeah, I guess so. And it's interesting to see, the lack of, I guess, relative action in the price since then, right? So it's been, if you look at this chart, I'm sure if you expand this chart a little bit to take that huge spike off, you'd see a little bit more variation. But the story isn't as quiet since then as it might look on this chart, right?
Yeah, I mean, this is only going through the early 2000s. So there was another big run up and spike in 2011. Didn't quite hit the 1980 high, but then there was another crash thereafter. But yeah, the point was after that initial crash in 1980, essentially went 20 years of going nowhere. Similar to price. If we had a chart of gold, it would look somewhat similar, just not as dramatic as this.
All right, let's jump into the second theme, or the second portion of this one, right? So another dramatic drop in the chart.
Yeah, this is everyone knows of this one, of course. This is the biggest bubble in the history of U.S. equities, and looking at the Nasdaq as a representation of tech stocks at the time. I think it was 60 something percent of the Nasdaq at the time were technology stocks, and in a period from late 1998 through early 2000, I think it was like a 18-month period, the Nasdaq composite triples in price in 18 months. So anyone paying attention today, things are pretty frothy. We haven't seen yet, at least, that type of just parabolic move in a very short period of time. Maybe we'll never see that again in such a huge index as the Nasdaq. And then, in March 2000, you had a lot of people saying that phrase, the market's got to be right. It's pricing in just a huge technology boom to come. There's the companies are going to be revolutionary. There's going to be earnings, and it's going to justify these multiples of 30 times sales and higher multiples on earnings. And of course, from there, everything changed. Sentiment changed. There was a 3-year bear market, essentially took the Nasdaq down 80%, and it took 15 years from that peak in March 2000 for the Nasdaq to hit a new high.
And Charlie, I'm reminded to one of the quotes we talked about last time in our webinar last month, which was, multiples are some value today multiplied by expectations for tomorrow, right? So expectations back in this time period were just sky high. Is it expectations that changed also that created the decline here? Was it information that investors got a hold of about what was actually underlying in these companies? Is there any story here about behind the chart?
Right. We always want that one little thing, like that bell.
What can we learn from for next time, right?
That changed everything. You can learn that sentiment's very hard to predict, at least a peak in sentiment. And when you get to that last stage, that last parabolic stage, and we've seen this with a number of assets class this year, you think it can't possibly go on any longer until it does. But there is a point of maximum positive or euphoric sentiment where it's just very difficult to get it to increase from there, and just steadily it slowly goes in the other direction, right? Where just people start to see that some of those companies, it started, in early, even before the peak in 2000, where a lot of the real high flying speculative names that had no prospect of earnings and had no sales, those started to come in first, right? So people started to see that risk wasn't being rewarded. And then ultimately there was a recession in 2001. So you could say that perhaps that was the undoing. The Fed also started hiking rates in 1999 and into 2000. So maybe that pressure, right, was put on it. So you had a whole number of catalysts, but it's ultimately, it was investors just couldn't be much more euphoric. So when the reality didn't meet those extremely high expectations, and the earnings were still pretty good in March 2000, it wasn't just any one number in particular. It was just, if you're expecting 100% growth and you get 50 or 40, and the thing is trading at such extreme multiples, that's all it takes. It's just a little bit disappointment, and then it essentially spirals from there. But I don't think anyone thought it would take that long to hit a low in 2002, or certainly if you talk to people in March 2000, if you told them we're not going to see these levels again for 15 years, they'd probably say you're crazy. But that's what happens.
All right, well, let's look at the next one here.
Yeah, this is one of my favorites because during the financial crisis in 2008, we saw a really extreme pessimism in the bond market, in the high yield bond market, where like never before, the default rate expectations were extremely high. So if you thought that last year during the COVID collapse they were high, they were multiples higher in 2008. So the yield on this high yield bond index hit 23% in December 2008. And just to give you an idea how high that is today. Today yields are around 4% on that same index. So investors were essentially betting at the time, or the market was betting that you're just going to have such enormous number of defaults that you needed to be compensated that high to take that risk. And if we fast forward from there, it was just an incredible comeback. By less than a year later, the high yield bond index on a total return basis hits a new high. The massive defaults that they were predicting just didn't happen. The market was wrong. And an investor who bought high yield bonds in December 2008 and held them for 5 years would have the highest 5-year return of any junk bond investor ever, at over 20% a year. So just, incredible returns. Whereas today you're looking at 4% a year, assuming there's no defaults at all, and assuming that the price of these bonds don't go down. So the lesson in the market can be very wrong in both directions, right? It could be euphoric, as we saw with silver or the NASDAQ, or they could be overly pessimistic, as we saw in December 2008.
Which sets up an interesting question for the next chart, right? When I first saw this chart, my eyes went directly to the right side of the chart, but I think the story that you talked about is on the left side. The expectations maybe were not eager enough to get into this asset, but what are we looking at here?
Yeah. So another thing that investors are, pretty poor at, and it's understandable why they would be, is pricing in exponential growth or exponential change, or an evolution or a disruption in a technology, via technology or a currency in this case. So in 2011, just 10 years ago, Bitcoin was around, it was trading. Not many people knew about it or talked about it, but its collective worth was less than $1 million of all that's all of the Bitcoin. And just this month here, we went over $1 trillion. So it's not to say that back then investors should have been worth $1 trillion, but for the collective market to be that off in terms of and that happened for years. If we keep looking here, moving down in 2013, it just looks like a little blip. I mean, that was a huge run up in 2013, where Bitcoin initially ran up to 1,000 and then it crashed. You could barely see that. And then of course in 2017, you see that run up again. And then it crashed again. And then on this run up, we go up to $1 trillion. So, whether it's something like a Moderna, which we've talked about in the past, or a lot of these technology stocks that are really creating a new industry, it's just very difficult for the market to get that right quickly, and it often takes time, and then it happens suddenly and all at once, and that's pretty much the story of Bitcoin.
Yeah. So before we jump into the next section, you're looking at all four of these charts. The story's obvious that the market priced in some wrong expectations, or whether they be optimistic or pessimistic. But in every situation, it seems like the longer term picture, things actually kind of smoothed out and the story played out properly. So is the market always right over a long enough time horizon? Is that more the question here? Is it looking at these short time periods and wondering, is the market wrong in a short window, but always kind of corrects things and finds a way to be right over the longer term?
I think you could make that case that it eventually will move towards where it should be going, right? And for stocks, if we're talking about stocks, it's going to go in the long run. It's going to be tied to earnings. Now, what multiple of that earnings is why you get these extremes. At some points in 2000, investors are willing to pay an extremely high price for earnings, and then in 2008, a much lower price, right? So I think from an investor standpoint, if you're going to think about having a diversified portfolio as an investor, and what can you do when the market is at some extreme, something in your portfolio is at an extreme? What's an unemotional way of dealing with that, or trying to avoid being susceptible to doing the wrong thing in terms of either during a bubble or a crash? And one mechanical way is just a simple, boring thing like a rebalancing, right? So if you had any amount of tech stocks in your portfolio in 2000, it would have very quickly become a high percentage of your portfolio. So you had a decision to make. And of course, you're not going to pick the top. You could have done it over a series of months or quarters leading up to there. But you could have said, I'm going to take some off the table. I'm going to reduce risk and take some from the asset class that's worked and rebalance and put it into the asset class, which back then weren't working, which would be something like value stocks or even bonds, right? And not with the idea that you can predict the future of what's going to happen, but just limiting your risk, right? Limiting your exposure to that asset class being wrong at the wrong time, right? So I would suppose investors in crypto at some of these things today will have to make that decision at some point because the exponential gains we've seen in the last year, they're going to make these outsized positions in their portfolio, and they're going to have to decide: do I want to have that much of my portfolio in one thing? They might say yes, right, if this is going to go on, or you might say, hey, maybe it's time to reduce risk. So I think that's just one way. That's the way I think about a mechanical way. If something's had an extremely long run and it becomes an outside position, that's the time to maybe think about moving in the other direction. And same thing if it's been beaten down, right? We talked about commodities early in the year and energy sector and things like that. And so that would have been a very small percentage of your portfolio. You could have rebalanced by adding a little bit to that theme, right? To the inflation theme.
Yeah. And certainly a concept that we're all familiar with, rebalancing. One that is maybe, takes a little bit of discipline when you're being so rewarded for holding an asset like this. But I love that concept of, instead of, with an asset like a cryptocurrency where you can't really look at earnings and see if it's overvalued from that perspective, are you overweighted in your portfolio in an asset with that much risk? And if so, maybe scale it back. That makes a lot of sense.
Yeah. Yeah. I mean, just Solana, I tweeted it out a few weeks ago. If you started the year with 1% of your portfolio in Solana, the cryptocurrency, and 99% in the S&P, as of a month ago, it would have been 50-50, right? That's how much Solana would have went up. So you have a decision to make. And I actually, asked the people on Twitter, what would you do? Would you rebalance? And of course, the crypto fan base says no.
The most logical place to get in.
Sell stocks and buy more Solana. And so far, that's actually been the right decision. So it doesn't always work in the time frame you're thinking. It's all about just probabilities and reducing that risk, right, of a large decline.
Right. All right. Well, let's jump into our next topic here. So, looking at 0% rates and why it makes 0 sense. I really liked this post that you did, so I'm excited to hear the highlights.
Yeah. So if I told you, if you were on a desert island in the last year, and I told you that the unemployment rate is under 5%, you have earnings at record highs, stocks at record highs, you have inflation the highest we've seen since the early 1990s. You have earnings in terms of employees up 4.5% over the last year. You have job openings at record highs. If I told you all of those things and asked you where you thought, if you were on a desert island, didn't know, where do you think the Fed funds rate would be? I'm guessing that you wouldn't say 0%.
I don't think so. I'd probably be excited to have spent the last year on a desert island.
Yeah, that would have been a good year to be there. That's for sure.
Probably be surprised by a lot of things, but this, no exception.
Yeah, so I think we could debate where central bank policy should be. Should it be 1%, 2%, 3%? Should it be higher? But I don't think many people can make a rational case anymore that it still needs to be at 0%, given where the economy is and inflation, and just looking at transitory factors, right? So the Fed's going to meet again in early November. I'm not so sure they're going to use that word transitory anymore, because it's starting to be clear to everyone that it's not. But what they often don't mention is talking about the wage push inflation that we're seeing, right? So it's pretty doubtful that all of these wage increases that we've seen from Target and Walmart and Amazon, every major big corporation has raised wages. It's going to be pretty difficult to bring those back down next year. I just, I don't see that happening. And what you're seeing companies do, right, if their biggest cost of most companies is their employee base, they have two choices here. One, they push those prices through to the consumer, or two, they take a hit in profit margins. And so far, what they've been doing is that first part, raising prices, right? So that's known as wage push and inflation. And I think that's a more difficult animal than perhaps maybe some of these commodities increases. The supply demand imbalance will cause them to come back down, or at least slow the rate of growth. But I think that the compensation, the earnings thing, is going to be prove to be more difficult.
And contrast this chart, Charlie, with a chart that we looked at last time. I think it was in our deck last time, looking at just the number of job openings, right? If wages are so strong and there are so many job openings and unemployment rates are still relatively low, how does the overall tension in the labor market play into this sense of inflation and low rates?
Yeah, it just adds fuel to that fire, right? You see help wanted signs everywhere, and that's going to push the demand for labor up. The supply is low, and basic economics tells you that they're going to have to incentivize new employees with higher wages. And we don't have a chart of this in here, but it's a fascinating one. The percentage of workers who are quitting their jobs right now is the highest we've ever seen. So there's a number of different reasons for that, but that's just adding to it, right? If employees, if they're not feeling happy or satisfied in the job, they're going to jump ship and go to the place that's going to pay them more, where they have more flexibility, and so forth. So I don't think anyone expected us to be in this situation when the pandemic hit, but that's where we are today. And the reality of it is that people are expecting higher compensation. Companies for now are passing it through higher prices.
And speaking of higher prices,
so
kind of shocking to look at. But
yeah, I don't know about you, Caleb, but in the past few weeks, it's really early in the year. You had the economic nerds and the investing nerds talking about inflation, maybe, but the average person wasn't talking to me about it. They didn't really care much about it. They're probably pretty happy to get the stimulus check, and things were looking pretty good. They didn't really care. Okay, a little bit of inflation, who cares? I think that's kind of changed with this last report, and just talking to people over this past weekend, a lot of people mentioning gas prices, heating bill expected to go up 50% this year. Going in the supermarket, if you're buying meat or fish or eggs and proteins, that's going up more than the rate of inflation. And so I think collectively these things are starting to be talked about a lot more as a potential problem, whereas initially it was, well, let's not worry about it. We'll worry about it later. And I think that narrative is starting to change.
Yeah, and you mentioned, the fact that this kind of crept up on us, right? But when you look at these numbers and how they've changed over the last year, it's certainly jarring to look at. As we jump into the next chart, I'll let you talk through this one, but then I think we actually have a chance to ask everybody on the webinar here for some opinions on what's been going on with this one too.
Yeah, so this is just a chart of the CPI. Overall, it's up 5.4%. And, a few months ago, the Fed was saying if it got to 3%, maybe that would be high. Even Janet Yellen said, yeah, maybe we'll see 3% this year, but it'll come back down. They were using the excuse of base rates, saying, prices were low last year. And so, it'll maybe go up in May and come right back down. So now we've had a few months in a row of 5+% CPI. And when the October report comes out in November, I think it's pretty sure it's going to stay up there, given what's gone on with commodity prices this month and other things. So this is proving to be much stickier. And the interesting thing is the expectations from consumers. And that's why I thought it'd be fun to just poll everyone on here. What do you think? Okay, so we got 5.4% over the last year in terms of CPI. What are we going to have in the next 12 months? Is it going to be less than 2%, 2 to 3%, 3 to 4%, or greater than 4%? So the historical average in the last 20 years is about 2%. So the transitory camp would say it's going to come back down to that level if you think it's going to be sticky. Obviously, it's we could debate, where it's going to be a little bit higher, a lot higher, but expectations are pretty important. So let's wait, just a few more seconds here. I'm interested. What's your guess, Caleb? Any guesses here? What do you think?
I think people are going to come in high. I saw your Twitter poll though. But
Okay.
let's give people a minute to answer this. Meanwhile, we got a question from the audience. Maybe we can tackle here in the middle, which is,
Yeah.
I
can't vote. I'm not allowed to vote. Okay. It doesn't count.
We blocked you. But in order to tame this inflation, if the Fed did want to take action, do they need to raise core rates higher than this, or raise rates higher than this core CPI number, or what other steps do you think they could take to try to curb this?
Yeah. So someone asked me that on Twitter today. What should we do here? And I would start by stop buying bonds. We got a housing number out today where prices were up 20% year over year. Highest rate of increase ever. The ratio of new home prices to incomes is at a record high. It's 6 times the ratio. And stop buying mortgage bonds. Like, let's start with there. Start with that. We don't need any more stimulus in the housing market. Stop buying treasury bonds. And then, 0% rates don't make any sense. So you start lift off. Does it have to go up to, where CPI is today? Hopefully not, because if they're right and it's transitory and it'll come down to, let's say, 3 to 4% next year, then they don't have to match it, right? What happened in the early 1980s, and that's where Volcker had to come in and straighten things out, is it got away from them. They would try to raise it a little bit, but expectations kept spiraling out of control, and eventually he had to really push it up, Fed funds rate into the mid-teens until it broke the back of inflation. So hopefully not, but let's get off zero because there's no fundamental case for it. And so, what I think the Fed, should be using some type of Taylor rule or some type of equation to say where it's going to be, because obviously just, having this small group of people deciding the most important rate in the economy, I think if they get it wrong, we're talking about the market getting wrong, and what happens if that small group of unelected people get it wrong, there's huge consequences for the economy and everyone. So I would love to see market-based rates, but that's not going to happen. Let the market decide where interest rates should be. But absent that, just be logical here. What's the risk of keeping rates at zero for another year versus the reward of that? And I think the balance is clearly shifted here to say, let's at least make an attempt here to keep our credibility on the inflation front. Like, the Fed has a dual mandate. One part of that dual mandate is keeping inflation under control, and they don't want to lose that credibility. So let's just start going. And there's going to be some pain. We all know that, but having inflation is going to be painful to a lot of people as well. And so again, balancing that risk and reward. Let's just get moving.
All right. Well, let's take a look at our results from the poll here, if we could. All right. So not quite as pessimistic as me, but kind of tilting towards the second half there.
Yeah. So we have a good portion of people say it's not transitory in the sense that it's going to come back down to the average level of the last 20 years. And, so if I had to guess, I'd probably be in that camp over the next 12 months as well. Could it get worse? Probably, hopefully not. But I think it's pretty clear that a lot of the supply chain issues are going to be with us for a little while. And that alone is going to drive, an above average level of inflation. And we haven't even talked about yet, obviously, the fiscal side, where we might have a few more trillion coming on the spending side, and what that might do, right? So that will obviously change the equation as well. But interesting results, good. And we do have a few, I don't want to discount, there are 3% who think it's going to come right back down. So we'll revisit this in a year and see.
You talked about that fiscal piece, right? How much of a disincentive is there to raise rates, knowing that, as a government, as a nation, we're probably going to have to borrow that money in order to fuel that?
I think that's a huge part of it. It has to be. They'll never admit to that, but it has to be, right? Just servicing that debt becomes very difficult at a certain level of interest rates, and they may not control long-term interest rates, but they're certainly buying their fair share right now, and raising short-term rates will likely have some impact on longer-term rates. And we're bumping up against 29 trillion here. We hit the debt ceiling they lifted the debt ceiling a few weeks ago, and then right away we added 500 billion in debt magically, and now we're at it again. So we're going to have those shenanigans again about raising it. But yeah, I think that, well, the question you're asking is, the Fed in some sense become a political animal tied to that fiscal side? And I think the clear answer is yes. I mean, they were cheerleading the fiscal bills even as COVID was getting better and you could see the economy recovering. They were saying we needed trillions more, so they were right on board with that. So Janet Yellen and Jerome Powell are very much of the same mindset, that all of this is transitory and that you can borrow a few trillion more without any consequences. So we'll see if the people start to push back, next year against that narrative. So that, comparing what we saw in the poll, this is just the New York Fed does a survey every month of consumer expectations, and the last one was at the highest reading. I think they started this in 2013. So the highest reading we've ever seen, which was 5.2%. So those are average expectations. And even looking 3 years out doesn't mean they'll be right, but people are expecting this to stick around 4% a year over the next 3 years. That would be something we haven't seen in a long, long time. So I think, of course, if that's the case, it'll be very difficult for the Fed to maintain that narrative, and they'll be doing something different next year.
Be interesting to see what the growth in wage expectation is right along here, right? Because you expect inflation, but are you planning for it, or are you just expecting that you're going to be taken care of on the other side, which is the income?
Right. What are you doing? Right. Are you starting? The question really is twofold. One, do you believe that your wages will keep pace with this inflation? Right. Because as long as they are, you feel somewhat insulated. And then two, when does it reach a point where you start pulling back on spending? Right. I don't think we've hit that point. There's still just a ton of demand. So the consumer thus far has been pretty immune, which is a reason why the companies have been able to push. You start to get used to it, right? Sure. People are talking about it. You start to get used to higher prices, and thus far they've been happy to pay them. But I think,
although the net savers are the ones that have been hurt the most in this, right? Because as long as you're invested in the markets, as long as you're working, you've been fine. But if you're sitting on a lot of cash, those are the ones that. Yeah,
net savers, retirees, although they did get a bump up in Social Security benefits, which is good. The biggest bump up we've seen since the early 1980s. So they got a boost in the cost of living adjustment, which would be good because a lot of people depend on that for their income. But still, it's going to hurt. It's going to hurt the people without assets the most, right? Because assets, will at least be somewhat of a hedge against higher prices. So, the notion that the Fed has stated many times that this is helping, this policy is helping the poorer segment of the economy, it just doesn't bear the facts, because the poorer you are, the higher percentage of your income you're spending on things like heating your home and gasoline and food at the store. Obviously, Elon Musk is not spending a huge percentage. I don't know if what is he at, 290 billion now? Yeah, I mean, I don't think he's worried about higher grocery bills. I could be wrong, but I don't think it's a concern for him. So
all right, so we've got several questions here about inflation. Yeah. Let's come back to this at the end.
Okay. Yeah,
I want to get through most of these charts. So
okay,
jump to the next topic, which is the great normalization.
Yeah, the great normalization. So the Fed is not the only central bank out there, right? There's central banks in every country, and at the start of this year, we had, that's the left side of the chart here, is pretty much the easiest monetary policy we'll probably ever see in our lifetimes. Hopefully, we had almost every central bank cutting rates last year, doing some version of QE, just extremely easy policy. And at the time, it seemed somewhat justified because inflation had cooled. You see some of those CPI columns, you see some negative CPIs there. And the thinking last year was, well, we're going to see deflation. Prices are going to come down because it's going to be a depression. This is when COVID first hit. So immediately all these central banks just cut like crazy. You fast forward today, it's very different picture. So on the right side, you'll notice immediately you got more red in that last move column. So a number of central banks have started this normalization process. So if we're looking at a lot of the emerging markets, right? So like Russia and Brazil and Mexico, they've had a history of dealing with inflation and viewing it as problematic. So they're not going to wait around like the Fed is. They've started to raise rates. They don't want to let inflation get out of control. South America, you're pretty much across the board, Chile, Colombia, Peru, we've seen hikes. And then we've seen some more developed nations start to move in that direction as well, with Poland moving, South Korea moving, New Zealand moving, Norway moving, small moves, not anything significant, but the great normalization is starting. And there's a very valid reason for that. If we go to the next slide here, you have a pretty much a monumental shift in the landscape, right? So instead of deflation that we were expecting, we got the opposite. We got inflation. And so the average increase among these central banks, the average increase in the inflation rates of their countries is 2.3% since the start of this year. And these central banks have only hiked on average 0.4%, with many of these countries like the US, the Bank of Canada, the Bank of England, not hiking at all, not starting the normalization at all. So what does that tell you? Behind the curve, and they're going to have to catch up. And so 2022, we should see a very different picture, if things remain the same, unless we see some type of unexpected deflationary collapse. You're going to have a number of these central banks, I think, scrambling to move back towards normal, right? Not even restrictive monetary policy, not anything close to fighting persistent inflation, but just going back to neutral, like, so to speak. So even if you think inflation is going to be 2% in the long run going forward, same as it was before COVID, a neutral policy would be right around 2%, right? And anything below that is still stimulative. So I think that's what we'll see. And on the next slide, I think where that's going to start is in that November meeting. It's going to start with the Fed's balance sheet, and what they're going to have is they're going to have to say is they're going to stop the increase in that balance sheet. They're going to slow it down over a course of a number of months. I think they should do it immediately, and at some point at the end of that, then they'll start talking about hiking rates. So the story of 2022 is going to be the story of normalization. And do we have that next?
Yeah,
there we go. Yeah, that's the balance sheet. So yeah, 8.5 trillion now, and pretty much every week it's hitting new highs. It's going to continue to hit new highs. It's just going to slow down. But that's the first step. That's the way the Fed did it in the past when they ended their QE. They don't like to spook the markets. They want to be very methodical. And their view is still very much this isn't a problem, right? So if you don't think it's a big problem, and you'll do exactly what you're doing, you take your time, you'll telegraph every move, and you'll just slowly slow the rate of growth. We're not even talking about unwinding it, right? Just slowing the rate of growth. So they're going to keep buying mortgage bonds in spite of housing prices where they are and everything else. And so on the last chart on here, in terms of the normalization, what's interesting is, although the Fed hasn't moved yet, right, in terms of rate policy, and they haven't really been very definitive at all in terms of when they might start hiking, the market is starting to move, the bond market. So these are 2-year yields at the bottom there. You got 3-year yields and 5-year treasury yields. All of them, if you notice, they're starting to creep back up. So what is that telling you? It's telling you the market's starting to finally price in some rate hikes. And if we look at Fed funds futures, what they're showing now, it's pretty interesting, is they're showing that the Fed is going to start hiking in June of next year, Whereas only a month ago, goes back to the story of people are finally starting to talk about it. A month ago, the market was expecting a December hike. So we've moved up 6 months in that very short period of time. And so, these rates still not to their pre-COVID levels, but as we get closer to those rate hikes, and if the market starts to price in multiple hikes, right, you're going to see these shorter term treasury yields start to continue to move up.
Not only are they moving up, Charlie, but you can see that spread increasing between them, which means the curve starting to steepen too. Is that a trend that you expect to continue?
Well, it depends on how much the market how many hikes the market prices in, right? If they start pricing in more longer term hikes, then yes, you could see that. It's very hard to predict the curves though, especially like a 10 to 2, right? Because at a certain point, rate hikes could cause, if you think that rate hikes at a certain point are going to cause a recession, right, and a slowdown in the economy, then at a certain point you'll see them invert, as we saw back in 2019, right? So it's not necessarily a formulaic in terms of you're going to see 200 basis points in hikes, and therefore the 10-year is going to be X percent more than the 2-year. It's hard to say that, right? It depends on what the market believes about long-term inflation expectations, and then what the market believes at a certain point is that rate hike going to start to impact the economy, where you're going to see a slowdown, then you might see long-term rates come down as a result.
All right. So thinking about rates and where they'll be, you did a really interesting post and spent some time, and I think this one stirred up a lot of conversation too, talking about just how portfolios need to be allocated now versus past times in order to reach kind of benchmark returns. So let's spend a little bit of time going through this one.
Yeah, this is hugely important for any investor. When you talk about returns, everyone has a different return expectation. But the one that a lot of pension funds have used over the last 20, 30, 40 years is this 7.5% kind of benchmark or kind of target return. So pension funds, endowment funds, they have to have some return expectation, to manage their projections, to plan for the future. And 7.5% has always been kind of around the number that they would use. But as we're going to show here, the way you get to that 7.5% has really changed dramatically over the last 40 years. So in 1981, it seems like it's crazy today to think that this was possible. You could have just bought 3 months treasury bill and at its peak had a return a yield of over 17%. So obviously more than double that 7.5% return target you could have got in 1981 for a brief moment in time. So you could add 100% allocation to just safe, boring treasury bills. Got to being confident you're going to get a return on your money. There might be some fluctuation in between, but at the end of the 3 months, you're going to get your money back and you're going to get that return. If we fast forward 10 years, the picture changed a little bit. So as you can see, rates have come down, pretty significantly from where they were 10 years earlier. The market talk about the market being wrong. They were very wrong in 1981 in thinking that there was going to be double-digit inflation that would continue, right? That's why those rates were so high. The market was expecting double-digit inflation to continue for 10 years, and it didn't, right? Inflation came down pretty significantly, and interest rates as a result came down as well. And what we saw in 1991, the 3-month treasury bill had come down, it was a little over 5% at that point. So you now had to buy the 10-year, which was I think around 8%. You had to buy some 10-year to get to that 7.5% return target. So you have to move a little bit up the risk spectrum. So the 10-year bond is going to be a little bit more volatile, right? Because it has higher duration. There's going to be more swings. Still pretty safe, right? If you're able to hold it for that 10 years. But you're the mix of assets that you would need to hit 7.5% changes, right? So now you're more heavily in the 10-year than the 3-month. And we fast forward in the post, I go through every 5-year period, so you could see, the more dramatic. But if we fast forward to 2011, this is where really when the game kind of changed. The Fed had, was right in the middle of their 0% interest rate policy for the first time. Now we're in it again. But if we look at 10-year Treasury bond yields, we're still getting a few percent back then. That's, it didn't seem like much back then, but today it seems like a lot. But none of those is going to get you to 7.5%. So what you would have had to do at that time was buy corporate bonds. You would have to buy some equities. And this is a chart, where we are today, 10 years later, is now we have even lower interest rates in 10-year yield, and corporate bonds are at all-time lows. And so this is a table showing what you would have needed to hit that 7.5% return target over time. And important assumption here on that is that right column, the equity column, I'm assuming a 10% return, which is obviously far from guaranteed, given where valuations are today. And there's been many 10-year periods where equities have done nothing. So, but assuming 10% return, you'd need, over 60% of your portfolio today in equities and the remainder in corporate bonds to hit that 7.5% return. And what you see in that bottom table is the risk. So investors now have two choices to make. They could maintain the status quo, maintain their old portfolio and accept a lower rate of return given where bond yields are. Or two, they can reach. And in reaching for that higher return, there's a cost, and that cost is going to be higher volatility, higher chance of drawdowns, right? Obviously, having 60% of your portfolio in equities, which can get cut in half, we've seen it twice in the last 20 years, equities get cut in half. It's going to be very different than having 100% of your portfolio in treasury bills. So no real easy answer, but this is a question that everyone has to be thinking about, that is going to really drive things in the future. So,
Charlie, given all of the excessive returns over the last decade or so, shouldn't all these pension funds be so flush that they can afford to stomach some lower than average returns over the next few years?
I guess they should be, but they're still, for some reason, they're still maintaining that 7.5 assumption. So they're still spending as if they have outflows, right? They're still spending as if they think they're going to get that 7.5 going forward. They might, right? But they're not without shifting that mix. They're not going to get it, maintaining any type of sizable position in bonds, right? It's mathematically impossible. It doesn't matter what we hope for. It's an impossibility. So, it's so far the investors that have reached for higher returns have been rewarded, right? In terms of bond yields have been low for a while now, right? We showed that at 2011 chart. And if at that point you adjusted and took more risk in equities, you've been more than compensated for that. But this has been obviously an unusually strong period for U.S. equity returns. And if the next 10 years are not as strong, it's going to be obviously impossible to hit that 7.5% hurdle.
And I have to imagine some of this is also leading the demand for alternatives, private equity investment. Are you seeing a lot of these funds go into that space to seek those kind of longer term?
That's the argument they make. I would caution, and there will be private equity and venture funds that obviously exceed that, right? If they have a winner in there, but private equity as an asset class, if their long-term returns are pretty tracked pretty closely the public equity markets for a good reason, right? If there's a downturn in one, it's going to be a downturn in another. So I don't think anyone would argue today that private companies are cheap and public companies are expensive. If that were the case, then I think that would be a good. So if they're both expensive, then they should both have subpar returns if that's going to happen, right? So, but yeah, that's the selling point. If you're selling a private equity, you're saying, look, you're not going to hit it in bonds, equities, or overvalued, just take more, go up that risk return, reach even more into something that's more binary. If you're talking about early stage venture or obviously crypto funds and things like that. So I think investors are doing that. But as we talked about in the last webinar, not all risk is rewarded. So just because you take that higher risk doesn't mean you're going to be rewarded. And it assumes that the end investor is able to stomach that higher volatility, right? Isn't retired in withdrawal phase, and just like their personality and psychology lends itself to having huge fluctuations. And that's not for everyone, which has been the historical case for bonds, right? It's just hard to stomach now because they're not giving you very much return. But not everyone could just change their risk tolerance when they want to, or when it seems to be needed. But they are going to have this question, and maybe it does meaning like, look, you have to, if you want to outpace or keep pace with inflation, you're going to have to take some risks today, and you're going to have to learn to stomach higher drawdowns, or you're going to have to just change your expectations, maybe work longer, save more, things that nobody wants to do, spend less, right? That's the other part of the equation, but that's not usually palatable to most people.
All right, well, let's jump into our last section here, and maybe we'll go through this one a little bit quickly, Charlie, just so we can get to some of the questions.
Yeah.
But you talk about risk.
Yeah. So the meme, we have the meme thing. It's still out there, right? It's every week there's a new one of these, but really the peak in the mentality that I could just chase a meme, follow the herd right into a name and have a good ending, have a good outcome, to that story. I think we've seen so many examples of it going the other way, and often the story is written about it on the way up, and then investors or making a killing, right, and hurting the short sellers or sticking it to the man. I don't know. There's all different rallying cries, right, for the memes. Everyone's got a different, but at the end, it's just herd behavior, and the idea that chasing early in the year in January, particularly at the peak in GameStop, was obviously the ultimate. There was this notion that just chase. This is the new market. You're going to be fine, right? Diamond hands. Don't sell it too, right? You had people telling you not only chase it, like the speculative thing without any fundamental reason, but don't sell it, because if you do, now you have paper hands, and you're not part of the group anymore, right? Where of course, the guys who are posting these memes, they're going to tell you when they sell their shares, of course, like they're never going to sell, right? They're never going to sell before.
I can encourage you to sell before that, right?
No. So we'll just flip through a few of these, and Beyond Meat was that first chart. Tilray was a very popular one. Just everyone has a similar parabolic move on the way up, and almost without exception, they've come down. What do we have? The next one, Bed Bath and Beyond. Yeah, that was so. You had some real interesting ones, of course. It was fascinating because the initial meme things was like, let's pick like a company that you think like doesn't make any, like they have just everything going against them fundamentally. Whether it's this or BlackBerry, like they just came out with things, companies that were past their prime, right, and drove these things up hundreds of percent, only to give it all back, right? And the last one, I figured let's end the way we started it, with silver, right? It's a very emotional asset class. People love silver, love it, but it never became, until the meme thing. I don't think it became. Maybe in 1980 it would be the exception. I'm sure there was a retail frenzy around that. There definitely was. But this year, for a brief moment in time, it was mentioned. The silver ETF was mentioned on Wall Street Bets, and it skyrocketed in a few days. And it was just fascinating. Like, do they think they can move the whole silver market? Well, they did very briefly, and as you could see, it just eventually came back. It came back in and started trading on other things. So
you say full circle, right? We talked about
yeah.
the volatility in silver, and you couldn't see it in the chart on that first chart. But also, ironically enough, over the last few months that we've done these webinars, we've had consistent questions about silver, right? So silver is an asset that people can't help but think about, and on the side of inflation hedging, right? It's got so much more to it than
why is it down over the last year? Why are silver and gold down? And we talked a little bit about that, but there's only one good reason. Investors are going to crypto as their new alternative for digital. It's digital gold, essentially, right? And Paul Tudor Jones, I think the other day, said essentially that. We've heard that from any number of investment managers. They've moved on from these what historically would have been the perfect environment, right? The Fed doing what they're doing, the fiscal imbalances. Just the story was as good as it could be for gold and silver, and so far, let's not count them out, right? Because who knows, right? A year from now, I would not be surprised if they go on a run. That wouldn't surprise me, but certainly they have competition in terms of for that story, and Bitcoin and these other cryptos have been a better story. They just haven't. There's no best story wins, right? There's just saying best story wins, and for now at least they have a much better story.
All right. Well, let's use our last few minutes here to tackle some of these questions. Before we do, I did just want to make a quick public service announcement. So all of these charts, as usual, will be available on YCharts. They'll be loaded up as templates. Also, all these charts are on your blog, right, Charlie? And you, I think, encourage people to grab them from there if they want to use them, in their own practice or with some of their
or if you want to dig deeper on any one of these topics, there's pretty much a blog post for all of them. So yeah, definitely.
All right. So first question, Charlie, you mentioned this term transitory, several times. It's been all over the press. How about just a quick dive into it? What do you mean by transitory?
So the Feds use that term, I think, perhaps mistakenly, in that the transitory, just the definition is just not permanent, right? Anything that's not permanent. So the Feds use that to say that the inflation we're seeing today is not permanent. I think the mistake in the messaging is, yes, perhaps the rate of increase is not permanent. So we might not see, we may not see 5% inflation forever, but that doesn't mean prices are going to come back down, right? And the notion that just because something is transitory doesn't make it problematic just goes against what I would argue is common sense, right? So you have inflation in Venezuela, thousands of percent. Right? Is that transitory? Sure, it is. It's not going to stay there forever. It's still a problem, right? You have in Argentina, you have just hyperinflation for years. It's transitory, believe me. It's not. It can't go on forever. It won't go. Nothing goes on forever, but it can still be a problem. The other thing is it just doesn't square with the logic they've used in March 2020. So in March 2020, they said, well, we have a deflationary shock, right? It's probably going to be short term, but it's a deflationary shock in prices to the downside. They're expecting this, right? Because people aren't driving, right? We saw it with crude oil. We saw it with any number of things. They're not going anywhere. They're not spending. There's going to be deflationary shock. Prices are going to come down. That's why we need to cut rates immediately to 0%, right? And do QE and so on and so forth. But when the narrative, the facts on the ground changed, right? And that proved to be transitory, didn't it? But they responded immediately to that transitory or potentially transitory. It didn't end up even materializing. Potentially transitory move down, right, in prices, right? They acted immediately. But here we have on the other side, they're saying this is transitory on the way up. Well, why wouldn't you at least bring it back to normal, bring it back to some sense of where it was before, even if you believe that it's not going to last? So they react immediately on the downside, but they're very slow to react on the upside. And the reason for that, there's there's a logical reason. They don't view there being any negative consequence. At least that consequence is too easy money, right? We haven't heard anything from the Fed in the from the tech bubble to the housing bubble, and any of number of things, negative consequences potentially of easy monetary policy. And they never once would admit to fault or admit to saying maybe we shouldn't have done certain things. So their view is very much that you can be very easy and that's fine, but you definitely don't want to be on the other side, which is too restrictive, right? And that's the view for now, right? And so what I'll say is when there's more pushback, right? Because we talked about the Fed being more political. If you hear on the political side, if both parties are starting to talk about this inflationary thing is problematic, believe me, they're not going to say that it's tied to that. Believe me, they're going to start to react to something, transitory. But again, you don't have to. Raising interest rates off of zero is not restrictive policy, right? It's just moving very slowly towards some sense of norm. Anyway, does that clear the transitory? So I have some strong opinions on that on that word, right? No, wars are transitory, famines are transitory, everything, but it's still important, right? It still can be negative enough where you should maybe start moving in a direction that will counteract that to some degree. I'm not saying the Fed has total control over inflation or anything else. They definitely don't, but they're definitely throwing fuel on that fire, right?
All right. I think we can cover a couple questions here in one and kind of wrap this up on one last question.
Good.
What we're really looking at is your asset allocation going forward with these different expectations. So if we're expecting interest rates to start to rise, we're expecting this higher inflation. When you think about allocating a portfolio for the future, what sectors do you like to be in? Do you still maintain that bond allocation that you would historically, or do you start to get, shy away from that? And, equities in general, how are you thinking about that?
Yeah, I think it's going to depend very much on your views on inflation, your views on how you want to utilize the bond portion of your portfolio. What is the purpose of it? What is it there for? Right? If you view the bond portion of your portfolio today just as a placeholder, right, until you see better opportunity elsewhere, then maybe you think about what we talked about earlier, going shorter duration in terms of not taking a lot of interest rate risk, so you could hold more cash, hold more short duration corporates, and with the expectation you're not going to earn anything, but until something becomes more compelling, either on the bond side or on the stock side, right? That's one way of approaching it. And on the inflation thing, it's should you have tips? We've talked about in your portfolio. We talked about that early this year. And really the bet there was, hey, if you think that inflation isn't going to come back down, tips will do better than treasuries. So far, that's been a good bet, right? But at the point where you think it's going to start coming down, treasuries will outperform tips, right? Because tips are going to require, ever higher inflation or higher inflation expectations for you to be compensated where they are priced today. And then with commodities, it's just been a good diversifier this year. Remember, before this year, commodities were in a bad bear market. I mean, just terrible. Didn't serve any use in your portfolio. But commodities are decent inflation hedge. They've been the best performing broad asset class this year. Is crude oil going to continue to run the way it's been running? I don't know. It's above $80 here. Could it go to 100? Sure, it could. Right. Anything that's happened before can happen again. But maybe you think about having an allocation to some broad commodities just in case this isn't a one-off. Right. It's all, to me, it comes down to risk management in your portfolio. Do you want to protect yourself for these different scenarios? So one scenario would be inflation averages, instead of 2% over the next few years, it averages 3 or 4%. And how will that look different? That might favor value stocks, as we've talked about, right, over growth stocks if interest rates are rising. you can make a case for that. All right. So just identify, everyone looks at different, identify where the pain point in your portfolio is and how you would be hurt in different scenarios. But I don't think for most people, they can just do away with that fixed income component, Caleb, because you just can't stomach the volatility of having 100% risk asset portfolio. Even if you think the long-term returns will be better, I don't disagree with that. If I'm going to bet 20 years from now, stocks versus bonds, I'm going to pick stocks, but that's not the question. The question is what happens in between, and can you stick with that? And most people can't handle, a 20% sharp decline. Definitely can't handle 50% decline. And having an all risky portfolio, you have to be willing to stomach these larger drawdowns. So just find that pain point. Think about different scenarios, both inflationary and both normalization, to occur, how that's going to impact your portfolio, and try to protect against any risk. And then, as always, look at what's helped this year and think about rebalancing, right? Look at what's done well for you over the past few years. And it's not easy to do this, right? Because that's what's working, so to speak. But that might be the most risky thing in your portfolio today. So that's the way I would think about it. Yeah, no, I like that. Everybody's different is the lesson, right? There's no one size fits all, right? Right. But there's also, I know you like to go 100% memes, and that's fine, but no. To the moon, right? No, to the moon. Yes. I think, again, just kind of circling back to where we started, and maybe we'll wrap up here, but having that disciplined approach, and you don't have to look too far back to see when a bond allocation actually really helped protect your downside, even if you go back to February, March of 2020. So that's exactly right. Right. At the end of the world, bonds did pretty well when the world was supposedly ending. You felt okay. And then you could have used that, even though they were earning nothing, right, at the time, could have used that again with the rebalancing to take some of that, put it into equities at a better value. So on the margin. So no picking tops or bottoms, just looking at extremes and trying to be prudent. I think prudence in short supply these days. So just always be aware of where you are in the cycle. All right. Well, Charlie, thank you. Pleasure as always. Looking forward to next month and all of the good content you put out between now and then. But really appreciate everything. And I guess if you have any last words, go for it. But if not, we'll see you in 30 days or so. No, that's it. Thanks, Caleb. Thanks everyone for joining. Thanks everybody. Take care. To next month.